retirement has a middle ground. Now, most people don't think it actually does, right? They think you're either grinding full time or you've stopped completely. But more and more, I'm seeing couples try something a little bit different. One partner scales way back, maybe 20 or 25% of their old workload, while the other spouse keeps working kind of close to full time. And you know what happens? The household still has plenty of income, their lifestyle doesn't take a hit, and their investments keep on compounding in the background. For many couples, this shift is creating a few extra bonus years of freedom without the financial stress of cutting the cord all at once. So in this video, we'll break down how this works, the pitfalls to watch out for, and how you can test to see if this partial retirement is a good fit for you. Let's dive in. Hey there, I'm Steve Willems, a CFP professional and wealth advisor with the Willems Wealth Planning Group out here in BC. On this channel, I help Canadians plan smarter retirements, reduce taxes, and ideally make better decisions in the years that matter most. Now, what's actually shifting in retirement today? Well, new StatsCan data shows a surprising number of Canadians are working past 65, but not because they have to, but because they want to. Take Canadian-born men aged 65 to 69. Roughly 30% of the guys in that cohort are still employed. And for more than half of them, it's by choice, not necessity. We can break this down by education levels, and the trend is even stronger, right? Among men aged 65 to 74 with advanced degrees, almost 39% are still working. And again, the majority say it's by choice. Even relationship status tells the same story. For Canadian men aged 65 to 74 in a relationship, about a quarter are still working, and 2/3 of those say it's because they want to, not because they have to. So the picture's clear. A growing share of Canadians are no longer treating retirement as a hard stop. They're working longer and not by necessity. And then there's this. This recent Retirement Outlook in Canada report study conducted by the Angus Reid Group in May 2024 found that of those surveyed, 16% of the retirees reported still working in some capacity and only 5% in a full-time capacity, but a whopping 79% stuck around part-time. And of those who retired in 2020 or later, a full 24% continued to work. But they're not working in the normal way. They're redefining it. They're scaling back. They're reshaping their roles. They're staying engaged on their own terms. So what does this actually look like in practice? Well, let's imagine a couple that I see all the time. So we have partner A, right? Let's say they're making $120,000 a year. Partner B was earning less, maybe $70,000. They've both been working full tilt for decades, saving aggressively, paying down the mortgage, raising kids, that kind of thing. Now the picture shifts, right? Partner A decides to cut back drastically. Maybe they leave their corporate role and they step into some type of part-time consulting or contract work. Suddenly they're earning $30,000 a year. Partner B sticks around in their existing role, but maybe also at a slightly reduced capacity. Maybe they're bringing in $50,000 a year. So between the two of them, they've got $80,000 of household income, but they've completely eliminated a ton of the stress of their full-time careers. And here's why this actually works. By this stage, the big ticket obligations that this couple previously would have faced, they're often gone. The mortgage is paid off, the kids are independent, the RESP contributions that they had to deal with are all behind them. And on top of that, they no longer have to shovel 20 to 30% of their income away into savings, right? So that part of their cash flow now gets freed up. And third, their investment portfolio, let's say it's got $1.5 or $1.2 million in it, it can actually keep on compounding untouched for a few more years. And if $80,000 isn't quite enough to cover their lifestyle, they can kind of sprinkle a small RSP kind of top-up withdrawal, maybe say like $10,000 a year, just to kind of smooth things out without really causing harm to their long-term plan. This is what we often call kind of the coast fire approach, right? Coast financial independence, retire early. And maybe in this case, they're not fully formally retiring early. It's the idea that once you've built enough of a nest egg, you don't need to keep saving aggressively. You can kind of just coast until full retirement. You can kind of let the compounding do the rest. I did a full video on that coast fire model a couple of months ago. I'll put a link to that one on the screen up here if you want to go deeper on that idea. Now for this couple, like after tax, if let's say they were bringing in $80,000 of household income, it's going to translate into roughly $66,000 net of after tax spending money. Now again, if they needed a little bit more, that small RSP kind of top up, it could get them up into kind of the low $70,000 income. And that's going to be exactly in line with what many couples are actually living on in retirement. So why are more employers actually saying yes to these kinds of phased or partial retirements? Well, the answer is pretty simple. It works for them too. According to that Retirement Outlook in Canada survey, employers are increasingly recognizing that retirement doesn't need to be kind of a hard stop anymore. These phased retirements are absolutely on the rise, and companies that embrace flexible or maybe fractional work arrangements can retain some of their experienced talent while also meeting the needs of older workers. It's a win-win. Like, just think about it. You've got decades of knowledge, experience, often professional judgment, kind of sitting in someone who's 62 or 65 years old, right? To the employer, many times that's gold, right? Losing that all at once can be really disruptive to the business, but keeping that person around, maybe even if it's just once a week on a project or maybe on a project by project basis, it creates continuity for the business while giving the employee a lot more lifestyle flexibility. This report also highlighted that employers who make these adjustments don't just get the benefit of kind of that knowledge retention, they also strengthen employee loyalty, they improve succession planning options, and they maintain a higher level of productivity. That's the kind of win-win that we're looking at here, right? The employee gets that softer landing into retirement, and the employer gains a competitive advantage in today's tighter labor market. So that's the employer side, but why are couples actually exploring this middle ground instead of just pulling kind of the full retirement trigger? Well, 3 reasons stick out in my mind. The first is just the couple side of the transition, right? Retirement can feel pretty jarring when one person goes from 100 to 0 overnight while the other person's still working full tilt. A staggered transition where one partner scales back but still earns while the other keeps working full time or maybe also partially steps back, it could help to soften that gradual shift, right? It's going to allow couples to almost like test drive what more shared time feels like without both of them suddenly being home every single day. And frankly, for a lot of relationships, this extra breathing room, this extra bandwidth is worth its weight in gold. Second is the lifestyle calibration, right? Partial retirement gives you a chance to live closer to your future budget without feeling deprived. You're still earning, right? Your bills are still getting paid. You can see firsthand if your assumptions about your hobbies, your travel, how you wanted to spend your downtime actually fit into your new lifestyle. It's a live fire test before the real retirement happens, and that tends to be pretty helpful as well. A third is the portfolio runway piece. Here's where the math matters in this. Let's say you're that couple with about 1.2 million bucks saved. By taking this kind of softer path and not drawing heavily on your portfolio, you're going to be letting it compound just a little bit longer, right? Out of modest 5% annual growth rate, that same 1.2 million bucks is going to grow to be worth 1.5 million bucks in just over 4 years, right? An extra $300,000 cushion without you having to lift a finger, without you having to save more, and hopefully without you having to compromise much on the life that you live today. And when you fully retire, you're going to be starting from a much stronger base. So the benefits aren't just about money, they're about pacing, they're about flexibility, they're about confidence that your retirement is actually going to fit you rather than surprise you. Now, of course, no strategy is perfect, right? There are benefits, but there's also a few things that you got to watch out for if you do take this path. But before we get into those, I'd love to actually hear from you. Like, if you could design your own version of a partial retirement, what would you want it to look like? Would you go kind of a couple days a week at your current role? Would you shift into consulting? Or maybe would you do something completely different, like go operate some heavy machinery for a couple of years? I'd love to hear from you in the comments. I'll read everything. Now let's talk about those pitfalls that you'll want to watch out for, both financial and personal. The first are going to be the tax surprises. When one partner is still working and the other has reduced income, it's going to be easy to underestimate how the numbers add up at the end of the year. If you start topping up your lifestyle income with those RSP withdrawals, you're going to want to push those discretionary draws, hopefully out to the end of the year when you know what your base income looks like after any bonuses have been paid or any distributions have been received, right? Overtime shifts taken, all that. And that way you're not going to be caught off guard with a tax bill that you didn't plan for later on. A second has to do with CPP and the post-retirement benefit. If you're between 60 and 65 and you're still earning, you got to remember that taking CPP early doesn't necessarily mean your contributions stop. You're going to keep on paying into CPP, and those contributions are going to create what's called the post-retirement benefit, or the PRB. This is a small lifetime top-up to your CPP, even if you're already collecting it. And it can be useful, but in many cases, the math is still going to favor delaying CPP until a few more years later, especially when one spouse is younger and longevity is on your side. A third has to do with spousal RSPs before 65. Now we've got this period between age, call it 60 and 65, before pension income splitting kicks in at 65, where a spousal RSP can shine. It's going to let you balance your withdrawals between spouses and smooth your overall tax picture in this period of time. But you're going to want to be aware of the 3-year attribution rule, right? If you pull money out of your spousal RSP too soon after contributing it, it'll be taxed in the contributor's hands, and it's going to wipe out the tax benefit that came from that strategy originally. If you do it thoughtfully, though, this can be one of the best tools in the playbook for smoothing tax returns in that interim period. The fourth has to do with lifestyle drift. Now, this isn't about overspending recklessly. The real risk here, especially as we're looking at a partial retirement, is failing to recalibrate. If you're no longer saving for retirement, but you keep living like you are, right? Like cutting corners, cutting coupons, skipping experiences, you might miss the window where you've got your health, you've got your energy, and you've got time on your side. On the other hand, some couples unconsciously let their spending kind of creep up, right? Because one of us is still working, or maybe both of us are still working, even if it's at a significantly reduced level. The key is actively checking your lifestyle against your plan, right? Are you underspending relative to what's possible? Or maybe are you overspending in ways that eat into your long-term security? Partial retirement works best when you're deliberate about where your dollars go. And last is just having to do with pension and benefit coordination. For those with workplace pensions or extended health benefits, just make sure you know what happens if you do go down to part-time or if you leave altogether. Sometimes reducing hours might mean losing valuable coverage that you might have been counting on. Now, this isn't usually going to be the deal breaker, but it's something that you want to have clarity on before you do flip the switch. So how do you know if this idea of partial retirement, or maybe staggered retirement, as some people call it, if this is right for you? Well, is it just asking yourself 4 questions? First has to do with energy versus income, right? Do you still enjoy parts of your work, or do you maybe feel that the full-time grind is draining more energy than it's worth? If yes, scaling back could give you a bit more balance without throwing your finances off. 2 has to do with your financial base. Have you already built a solid retirement foundation? Is that mortgage paid off? Are the kids launched into adulthood? Is the retirement savings at a healthy level? Has the plan been run, right? This option often works best when your savings is now at the level where it can coast for a few years without constant contributions. 3rd has to do with employer flexibility. Here I'd be asking, is your role one where your experience is valuable enough that your employer might want to keep you around at a reduced capacity? If not, maybe could you look at adjacent areas? Could you consult or freelance somewhere else in your field? And lastly, 4th has to do with lifestyle fit. Here I'd be asking, can you meet your lifestyle spending needs mostly on one reduced income? Or maybe if you had to top up a small contribution from your RSPs here and there without feeling pinched, could you pull that off? Like financially, could you make the numbers work? If you answered yes to most of these, like partial retirement might not be a dream. It could actually be a realistic path for you. And keep this in mind too, right? This stage of life, it doesn't actually need to last forever. You could do this for just 2 years. You could do it for 5 years. You could certainly go longer. The point is, it's going to buy you flexibility. It's going to give you portfolio a little bit more runway to grow. And then it's going to let you start testing what retirement might actually feel like without slamming the work door shut prematurely. And hey, if you're not sure whether or not you're ready, or maybe what the best way is to test this, the best way is to actually run your own numbers, or better yet, like get someone outside of the fishbowl to do it with you. That's the kind of work that we do every single day here for our clients. I'll chuck a link in the description below if you'd like to book a time for us to take a look at your situation. But otherwise, that's all for this week. I hope you found that helpful. I'll see you in the next one.